Hello, my name is Roger Jacoby, and I'm the VP of Business Development for a company called Fiscal Advantage. This presentation is going to introduce you to Fiscal Advantage and show you how we are working with Vistage groups across the country. Fiscal Advantage was founded after the 2008 market crash. It was founded by a gentleman by the name of Dan O'Connell. Now, Dan had spent the prior 20 years of his life running a small M&A firm here in the Midwest. After his business dried up after the crash, Dan decided to use his extensive experience to help small and medium-sized businesses improve their financial performance. He realized that the small and medium-sized businesses that he had been working with really didn't have access to the same kinds of insights and tools that the larger firms did. So he spent the next several years developing software tools to quickly and efficiently analyze the financial statements and prepare reports to help businesses that wanted to thrive. Over the years, over $1 million has been invested to bring Fiscal Advantage to market. Now, really, data is one thing, but clearly what we've learned is that what most businesses need is, if you will call it, an external financial analyst. And that's what Fiscal Advantage's core business is. We meet with businesses on a quarterly basis, we go through their financials, and we help them analyze and see data and trends that they're not normally seeing in their normal course of business today. Well, it turns out that in late 2016, one of our largest customers was a company by the name of Pacific Advisors. Pacific Advisors used the Fiscal Advantage tools with some of their business clients, and they were pretty impressed to see the response of those business clients. Rarely had a large, successful financial services firm come alongside their business clients and tried to help them to improve cash flow, profitability, and even business value. The impact on their business clients was so successful that in early 2017, Pacific Advisors acquired the Fiscal Advantage technology and their key employees. The CEO of Pacific Advisors, Kelly Kidwell, was part of a Vistage group in Southern California, and he approached his chair to determine if there was a need for a simple, high-level version of the in-depth analysis that we normally do, if this was needed by Vistage groups in order to have a meaningful discussion about KPIs and financial performance. Well, the feedback by the chairs he talked to was very positive, so in early 2017, performance leadership was introduced to the Vistage chairs at their national convention. And I'll show you a little bit about this product at the end of this video. In addition to being a member of Vistage, Pacific Advisors has also provided speakers to Vistage groups on advanced financial strategies to help business owners keep more of what they earn. Pacific Advisors acquired Fiscal Advantage to broaden their product offering. As a financial services firm, Pacific Advisors works with business owners in regard to tax, compensation, and many of the areas that you see on this screen. Today, we're going to focus on helping businesses identify performance efficiencies. Every business has financial statements. The difficulty is identifying the areas where a business is doing great and the areas where there might be some opportunities for improvement. So for our Vistage offering, we have distilled all of the financial statements down to the 7 cash drivers of the business. When you think about it, there's only 7 places where cash comes in or goes out of a business. Not surprisingly, they can be found on the 2 primary financial statements. The first 3 are found on the income statement: sales, cost of goods sold, and operating expenses. And when we look at these 3, we're looking to manage margin impact. Now, note we don't look at the derivatives like gross margin or profit. Those are mathematical computations off of these primary drivers. When we look at the balance sheet, we look at receivables, inventory, and payables. And when we manage these, we're looking to manage the cash cycle impact of those accounts. And finally, we have capital expenditures. And when we look at capital expenditures, we're looking at asset utilization. So our proposal today is that if we look at and better understand these 7 different accounts in any business, recognizing not every business has all 7, but if we look at these 7, we can get some key insights into the business. So let me tuck those off to the right. Let me introduce you to a way that we want to monetize those 7 cash drivers. We're going to start with an equation. The equation is rather simple and straightforward. First is something attainable. Well, what is attainable? Well, it's kind of what we could have gotten for each of the cash drivers. I'm going to define attainable in a couple of slides, but when we think about something we could have or should have attained, and then we subtract what we actually did, we end up with something we call unclaimed profit. Why is unclaimed profit so important? Well, if we can identify unclaimed profit for any business, what we're going to see is that unclaimed profit drives 3 critical things. First, it flows and helps the cash flow of the business. Secondly, profitability will impact the credit worthiness of the business. And finally, if our profitability and cash flow improve, so should our enterprise value. This is important because if we think of growing our businesses, the money to grow our businesses will come from one of these 3 areas. It's either going to come from the cash flow of the business, we're going to go to the bank and borrow the money, or we're going to have to sell equity. So clearly, if we can identify some of this unclaimed profit and capture it, it's going to have a significant impact on the financial health of the business. So let's now look a little more in depth at this equation. And I mentioned attainable. So how do we determine what a business could have or should have attained? What is attainable? Well, there's really 2 places that we find attainable numbers. The first place we look is the industry benchmark. And where we look here is at our industry average. Now, you may not know it, but all banks submit data on businesses that give them their financial statements. And this is actually the largest database of financial performance anywhere. There's over 250,000 companies that have their data in this database. It's managed by a company out of Philadelphia called the Risk Management Association. And the Risk Management Association compiles this data and licenses it back to the bank. So if you go to the bank and look for a loan, they're going to compare your performance compared to your industry average. So one of the things we should look at when we're looking at attainable numbers is how do our numbers compare to our industry average. The second area that quite often is often overlooked is company performance. When we look back in the last 3 years or so, how has the company performance changed? Has the margin eroded? Has our cash cycle lengthened? Are there areas of the business that maybe have not grown or gotten better compared to other areas of the business? So we're going to look at a company now and we're going to look at their attainable numbers. We're going to subtract where they actually are, and we're going to identify the unclaimed profit for the 7 cash drivers. So let's now look, and what I want to demonstrate through this next analysis, this is, by the way, a real company, and we're going to look at this company who's having around $5 million in revenue. You can see that on the left side, and about a 15% return on equity. And I'll show you their specific reports in a few more slides, but you'll see later that we've clearly identified that for this business, the issue is their cost of goods sold and their inventory. Clearly, with those 2, this is a manufacturing company. So I'll bring those over to the left, and now I'm going to bring back my equation here, and let's talk about what this business actually attained in those 2 key cash drivers. When we look at cost of goods sold, the business is currently at 72%. Well, it's kind of hard determining if that's a good number or a bad number. So let's look at what's attainable. When we look at what's attainable, we see that the industry average is 64%. That's that 8 percentage points difference that their performance is lagging, if you will, is costing this company a considerable amount of money. When we look at the company best, it turns out that 2 years ago, the company was at 70%. They've actually lost 2 points of margin. Now, to show you here how we're going to monetize these, we need to set a goal of what we can accomplish as a company. Clearly, we'd love to hit the industry average, but that may be too aggressive. We hope we can do at least as good as the company best. So let's split the difference between our current performance and the industry average, and let's set a goal, a target of 68% for cost of goods sold. When we look at inventory, currently we're at 106 days. Turns out the industry average is 83 days. Turns out the company best is where we're at today. We're at our best. We've been improving our inventory. So clearly you can see here, hitting our own company best isn't going to help us at all. And again, for the sake of argument and to show you why we're going through this analysis, let's set a goal for inventory of 90 days. Now, if we hold the other 5 cash drivers constant and we just achieve these 2 targets, what is it going to mean for the impact on the financial performance of the business? So as we look at the impact, we want to bring back our equation up here of why unclaimed profit is so important. And if they could achieve changes, if they could achieve those targets, what is going to be the impact on cash flow? What's going to be the impact on credit worthiness? And finally, what's going to be the impact on the value of the business? Well, after just 1 year, after attaining those 2 targeted levels, we're going to actually add more than $214,000 in cash flow. We're going to add over $500,000 of debt capacity, and the number that kind of surprises me the most is we're going to add over almost $1.2 million to the value of the underlying business. Now, jumping out to year 5, by the end of year 5, after attaining these new targets, we're going to have added over $1.5 million of cash flow, over $1 million of debt capacity. And again, the number that just surprises me is we're going to add over $2.2 million to the valuation of this particular company. So what we see here are the values we've attained in year 5 for those areas, but we need to remember that the company was still existing. What if they had just moved forward on their current performance? They'd not made any of the changes. As you can see here, this is what the values would have been at the end of year 5. So when we add the status quo, if you will, and add to it the added value of being the targets, what we see here is by achieving and going after cost of goods sold and inventory improvements, we've helped a business go from 3.8 million to almost 6.1 million. And you can see the other changes here. So this is really why we're focused on the 7 cash drivers, identifying where there's opportunities for improvement, and then monetizing those. I briefly mentioned that the industry classification system that the database that we use comes through the banking industry, and it's organized by industry code. The only other thing I wanted to mention quickly is we have found in talking to businesses that many businesses have gotten much more complex in using one single code to describe everything a business does. It just doesn't work for most businesses. So if you work with us, we will then work with you on the industry codes, and we will let you pick up to 5 different codes. So you could say, for example, 50% of my revenue came from this code, 20% from this code, and 30% from this code. And then we'll use our software to create a custom hybrid industry comparable. So we're trying to really compare you to a mirror image of your company. Finally, we just wanted to acknowledge that not all cash drivers, not all of the 7 cash drivers mean the same to every business. So as we look at the different what we call meta sectors. And if we divide the world into manufacturing, distribution, services, and retail, and we look at the importance of the different 7 cash drivers, we can see in manufacturing, certainly cost of goods sold and operating expenses, as well as inventory and capital expenditures, create a very complex environment for many manufacturing businesses. When we move to distribution, they generally don't have control over cost of goods sold. What needs to be driven here is sales, and capital expenditures are often less important. When we get to the service industry, most service businesses don't have an inventory, and depending how they account for their cost of sales, some services businesses don't even have cost of goods sold. And whether or not capital expenditures are important to a service business varies widely based on the type of business. Finally, when we look at retail, certainly cost of goods sold and inventory are driving factors along with top line revenue. But if it's true retail, paid for at the point of sale, then rarely does receivables have much importance. The importance of this graph is just so you understand that not all 7 cash drivers have the same equal importance to all businesses. It does vary widely. So in summary, what our goal is to work with you as a Vistage member and understand how your business is performing on the 7 cash drivers. Where possible, where we can identify unclaimed profit, we want you to understand that if you can make improvements in those areas, how it's going to impact favorably the financial performance of your business. And as we've seen in our example today, by making modest improvements for this particular company in cost of goods sold and inventory, we are able to see significant improvements by the end of the 5th year. So that kind of concludes the overview. Now I'd like to just tell you a little bit more about what we're doing with the Vistage groups and what that looks like. We have a product we're calling Performance Insights, and specifically Performance Leadership. Every quarter, every business that participates gets an Excel spreadsheet and fills in 14 pieces of information. This is very straightforward: revenues, cost of goods sold, operating expenses, etc. We take this data, we put it into our software, and every business every quarter gets a 2-page high-level analysis from us. 1 page on the income statement, 1 page on the balance sheet. Let me just show you the company we've looked at today and what their report looks like. So if we look at the company we see today, the reason you can see we've picked cost of goods sold is if you look at the top, you can see revenues and operating expenses are highlighted in green because those are doing fine. Cost of goods sold is highlighted in red, or more likely brown, but let me walk you through the numbers going across the top. Under the cost of goods sold, 4.1 million is where they ended up the last fiscal year. That was 72.7% of their sales. The next set of numbers, as you can see on the tops, is at the company best. This is where we can see that the company 2 years ago was at 70%. Now what we want to do is monetize that. So what we tell the business is if you could get back to 70%, you were already there 2 years ago. If you could get back to 70%, it would actually add $159,000 in profitability every year. The third set of numbers there is at the industry average. So that says the industry average for cost of goods sold is 63.6%. Now, I'm not saying they can achieve it, but it's important to know that if they could achieve the industry average, their profitability would improve by over $500,000. So clearly we have identified for this business, cost of goods sold could be an area that we want to focus on improving. Now the graphs are sometimes easier to see the story. You can see the revenues in the blue charts there are going up. Cost of goods sold, now the green line is the company, the red line is the industry. And as an analyst, the thing that concerns me most is that the distance between those two lines is getting greater. Now, as I mentioned, we not only want to identify opportunities for improvement, but we also want to identify the areas where the company is doing great. And operating expenses, that graph, operating expenses as a percentage of sales, clearly the company has operating expenses under control. As revenues are increasing, the percentage going to operating expenses continues to decline. That is a very positive message for this business. Now on the second page, we look at the balance sheet. And again here, receivables are doing great, so it's highlighted in green. I mentioned this company has some opportunities in inventory. So reading across those numbers, 1.2 million is the inventory level at the end of the last fiscal period, which represented 107 days. Turns out the next set of numbers, 107 days, is the best they've done. So achieving that isn't going to add anything to cash flow. But the industry is sitting at 83 days. So that last number says that 83 days, if they could achieve the industry level for inventory, it would improve cash flow by almost $70,000. And again, the graphs are sometimes easy to see. The middle graph, inventory days, you can see the green line is the best it's been in 3 years. The number there says 106.59, and clearly that is the best it's been. The industry is getting worse, but the distance between the green and the red lines at that last data point is almost $270,000. Now, this is a report that's given to every company every quarter. Well, in addition to helping the companies see their numbers, we also want to facilitate a meaningful financial discussion at the group level. One of the core principles of Vistage is members who've solved problems helping members who are going through those problems. And so at a group level, we want to distill this data down from each company in a way that can facilitate a group discussion of financial performance at the group meeting. So I know you can't read it, I'm going to zero in on it in a second, but on a high level, if we look at this, the members are listed along the left-hand side in blue. Across the top are the 7 cash drivers, and then each cell is highlighted differently. If a cell is highlighted in green, as you can see in the top, it says they're performing above their comparables. If it's highlighted in pink, that means there's an opportunity for potential improvement. And so let me zero in and show you what the row looks like for the company I'm looking at today. The third company down here, called I am a owner, here as you can see the second column of data, cost of goods sold. There's those numbers we've been looking at today. They ended up fiscal year at 72.7%. They ended up with 4.1 million in cost of goods sold. There's the industry average at 63.6%. The company's best at 70%. And the financial windfall, if they can achieve those numbers. 3 columns over to the right are the same things with inventory. 107 days, the industry's at 83. As I mentioned, this company's doing a great job on operating expenses. So the third column, operating expenses, they're at 25%, the industry's at 30%, and 25% is the best they've ever done. So again, the goal here is that companies that are in green might be able to provide some help and insights and ask some powerful questions to the companies that have particular data highlighted in pink. So that is what we perform for many Vistage groups across the country. There's a deliverable to the member in a 2-page report, and there's a deliverable to the group as what we call the group at a glance that shows everybody's numbers to facilitate that deep discussion at the group level. Finally, just quickly at the very beginning, I mentioned what we do at Fiscal Advantage. Our core product is to help business. I just want to touch on that with 1 or 2 slides here. Clearly, what we want to become to businesses is their external financial analyst. And as we look, we deliver different things in different quarters where we give the business everything from an enterprise valuation to in-depth discussions on sales and cost and margins and break-evens. And with historical data, our software is very powerful in helping look forward to budgeting and forecasting and even financing and how to structure debt. So clearly there is a very in-depth analysis behind the numbers that we're providing to Vistage groups at the summary level of the 7 cash drivers. Thank you very much for your time today. We look forward to working with you to identify opportunities to improve cash flow, profitability, and business value.